Okay, so let's talk about some more strategies as we get into this portfolio management. What if you're running statistical arbitrage? Well, what do we know? That you're making a lot of use of technical stock prices and volume, and you're looking for pricing inefficiencies. So a lot of my economic training, there's one thing that I always keep coming back to. This reversion to the mean seems to be something that holds up pretty well, especially through history and back testing. Now, what can we do in this statistical arbitrage? So one of the things that we do, and we do this oftentimes in alternative investments, specifically in hedge funds, but oftentimes we'll use pairs trading. So we're going to look at breakdown and stock correlations. We might actually look at market microstructure. Are there supply and demand imbalances? And think about what's been happening in the industry. A lot of times as a fund manager, you might want to buy a stock, but you've got to break down that trade to make people aware that you're not picking a large position into this. So the market microstructure becomes extremely important, especially in arbitrage strategies. Now, what about an event-driven strategy? So what are we trying to do? Ultimately, I just want to basically exploit market inefficiencies around corporate events. So where do we see this? Mergers and activity. This is a big area. Hey, who's buying whom? What are some companies? Hey, you got so much cash on your financial statement. Are you saving it to buy a firm? Who are you going to buy? So one idea, this idea of cash merger, some firms will actually buy shares of a target company after a deal has been announced. I'm not so sure that's the strategy because then it's already priced in the market. What the good people in event strategies do, they're looking for the company that might be a buy over target before it's announced, before it's commonly known. And then one of the merger arbitrage strategies that we'll talk about in alternative investments, hey, what typically happens, the acquirer often overpays for a company. Their stock price runs up, and then the target actually goes up. So what we can do is oftentimes these synergies don't work. Sometimes these companies merge together, there are culture problems, you don't get the synergies that people thought. So merger arbitrage will come in, you'll often short sell that acquirer, and then you're going to buy shares of a target company. Now let's look at this whole idea of fundamental active investment process. So again, I know I've gone over list after list after list. There are a lot of lists in this sector. I always want you to remember, focus on the big picture. And then again, you should not be spending all of your time allocated for studying dealing with equities. It's just simply not that heavily tested on the exam. And there's just a lot of lists here. Don't memorize every list. Just understand the basic concepts and go into the exam and do your best. So what are you going to do? If I want to set up an investment process of active management, well, first thing, I got to have a target. I'm going to define my investment universe. And then I'm going to have some type of screening tool to basically obtain a manageable set of securities. My team, we always kept about 40 to 50 securities that we kept our eye on, but maybe weren't good enough to put in my portfolio. So we were always adding and subtracting from these future stocks that might make it in the portfolio. I say from a fundamental perspective, you need to understand the industry. You could have the best industry in the world, but if the stock market is really bad because the economy is in a recession, it doesn't help you. You're not going to have a good return. You also need to understand the competitive position. And again, financial reports. And I know you covered this in level 1 and 2. There are no specific accounting topics covered on the level 3 exam, but that doesn't mean that you can forget about accounting. Remember, financial reports, they're snapshots during that time period, and they tell a story. You need to decide as a buyer, do you believe that story? Can you dig a little bit deeper in the footnotes? Are there things here, maybe in their sustainability report, that hasn't been linked to their 10K? You got to do some work here. Okay, and then the next thing you've got to do, you're going to have to forecast performance. Is this stock undervalued or overvalued? So again, you're going to convert these forecast evaluations, and then you're going to build this portfolio with your desired risk factor. Whether it's factor or beta, whatever it is that you're looking for, you're going to build that portfolio. And don't forget about, I think, one of the most critical parts. Most people have a great buying in strategy, but they don't have a good sales strategy. They don't have a sell discipline. That was one of the things that I struggled with as a beginning portfolio manager. I was fantastic, I think, of coming up with the price of what it should be. And then when it reached that price, I'm like, what do I do? Well, what we started to do is we put in sell disciplines. So once it hit that price, it automatically triggered a reevaluation of that stock, and we would either say it's worth more going forward, or we would just immediately sell it. So incorporating sell disciplines is extremely important. Exiting the position might be even more important than when you buy it. Okay, so we couldn't get through this without bringing back another subject that's an important subject, but again, not heavily tested. Behavioral finance is going to be on the level 3 exam. Most likely it's going to be in the constructed response in the morning, but again, it's not heavily tested. So what are you going to do with behavioral finance? Just like we talked about before, pick a couple of your favorite basically heuristics and be able to demonstrate how this could make portfolio management harder, how this could harm your portfolio. So guess what? Behavioral biases affect human judgment. Unfortunately, from economics, I was taught that all people are rational. And once you make that distinction, you can do all this great mathematics, you can do all this great factor modeling, and it's really impressive. The only problem is it didn't work. And I think part of the reason it doesn't work is behavioral biases. And again, from the behavioral bias section, pick out a couple that you like, that you see heavily tested in the material, and know those. So confirmation bias. Hey, I just bought this stock. I just went to a convention. Everybody else bought this stock. Okay, I must be on the right thing. Illusion of control. Availability bias. Loss aversion. Loss aversion, I have to tell you, even for professional money managers, is a big deal. I don't like to admit that I made a mistake. It still bothers me that I didn't buy IPO shares of Facebook. But again, looking backwards, I was much more accurate than I was looking forwards. So I don't want losses. So what happens with loss aversion? I want you to think about how this impacts your portfolio. That means I'm likely to hold losing stocks until they break even or reach some point. And I'll sell a stock just so I can have a win, so I feel better about myself. Overconfidence, regret aversion bias. Then we can get into value traps. Anyone that's followed GE stock for the last few years, I've seen analyst report after analyst report from some of the top money managers in the world, and GE was a great stock. It's attractively priced, it's attractively priced, attractively priced. Then it's kicked off the Dow Jones, hard to trade, and now all of a sudden, it still might be overvalued. Growth trap. Hey, let's talk about Tesla. Tesla's a great company to think about. If they could build the car for $30,000 like they say they can, they're going to be a major force in the auto industry. But the problem is they can't seem to build a car for $30,000. They can build a great car for $100,000. But to go into mass scale, you've got to have economies of scale. You've got to have the right technology. You have to have the right experience. So just because I think this has a huge potential, can they execute? Can they build that car for $30,000? That remains to be seen. So let's talk about quantitative investment strategy process. We talked about the qualitative. Well, what about quantitative? It's not that different. We need an investment thesis. What is the market opportunity? I got to get data. Luckily for us, in my career, I have never seen more data available. These were their databases. Even simple internet search engines provide powerful data. The problem is it's just data. Unless you do something with that data, it doesn't mean anything. The whole goal is using all of this data to make informed decisions. And then, of course, if we're going to run a quantitative model, at least it better work looking backwards. If it doesn't even work looking backwards, nobody's going to give you money to try if it continues to go forward. Then every once in a while, do a stress test. Do a scenario analysis. Hey, the CFA Institute's favorite words, Monte Carlo simulation. Let's take a look at some out-of-sample testing. What happens to this quantitative process if we use some out-of-sample testing? And then finally, you're going to build this model. You're going to minimize trading costs if you can. Try to match up the risk that you can. But the last thing I want to talk about on this that we really didn't emphasize, you got to monitor this portfolio. And again, you can do this automatically with quantitative systems. You don't have to have an analyst sitting there watching it. You can program this so once something happens, it automatically trades. That's what a lot of folks are doing out there that run quantitative models. So guess what? Just like in qualitative models and fundamental models, there are pitfalls in quantitative models as well. Hey, when we get to alternative investments, survivorship bias, guess what? All the companies that failed have been taken out of the benchmark. Well, is that a real benchmark? What about data mining? I had some fun with this as a beginning analyst. It turns out that there is an extremely high correlation with the stock market and the growth of Christmas trees. Does that mean if the Christmas tree grows at the rate that the stock follows? No, that's absurd. But I can make a strong case where I can get a correlation, maybe 0.8, 0.9 of basically the S&P 500 and the growth of a Christmas tree. At least during that time I did. The other thing that we can do, and we have to think about some pitfalls, what if we have all these short sell ideas, but the stock's not available for short sell? Or even worse, the downtick rule. You can't basically sell that stock. If it's dropping, it's got to go up before you can sell it. And then again, what we seem to always forget, transaction cost, trading cost. So again, direct, people seem to focus on that, but indirect is really where the big danger is. There are so many additional costs from indirect trading, and we'll cover that later on in the material, absolutely critical. So again, we covered a lot of information here, but the processes are very similar. You have to figure out your target. You have to have some way to quantify all of these investments. Then you've got to make a decision, and then you've got to monitor that decision.